Hello, everyone. We're 6 p.m. right on the time. Today we're going to focus on income investment. In the past couple of sessions, we talked about various different topics. We talked about education bond. We talked about strategies around tax savings. So today we have the pleasure to invite Alan to join us to give us this session about how we can really invest, build our portfolios, create our wealth with fixed income investment. Just really briefly introduce Alan. He's the managing director of Candor Capital. He has years of experience as an advisor, as a fixed income investment specialist. It's truly a pleasure to have him today to walk us through, what is exactly is in fixed income, how we can use them, where we can get these investments. So without further ado, let's get into a quick introduction, Alan, for yourself, and then we can get the session started.
Thanks, Frank. I guess you already said everything. Probably not much, for me to add. I guess being in, I guess in the fixed income space for me personally, about 25 years. It's I think I guess my background is more about product dealing, structuring, and also distribution and issuances. I think over the last about 7 years we've been very focusing on delivering that expertise of our experiences. We think the financial advisors, I guess, channel. I think we provide a lot of support, for example, like Frank and other advisors that to help the clients to navigate and also selecting the right solutions in certain part of portfolio that they require fixed income. So that's kind of our role, and hopefully that we can share some of our knowledge with the audience too. So thank you.
That's great. Thanks so much for the introduction. I understand when we talk about fixed income, usually people will think about, oh, we're going to talk about government bonds, or we're going to, talk about deposits, we're going to talk about interest. It looks like it's pretty boring stuff to to most people. But the more I learned from Alan and the different types of investment strategies that we can actually work, and also the way that we think about investment strategies are entirely different. So this is really exciting for us today to have a little bit of a deeper understanding of how this is playing in our wealth creation. So you can see today we're going to cover a few important topics. First is really helping us to understand what exactly is a fixed income. Is a really broad term, and what exactly we can find, specific investment categories under that fixed income term. And also when we talk about maybe bonds and other investment, how this is going to work with different strategies. And obviously, how this is really helping us to create wealth, providing consistent income, and also how we can get them. That's the that's the most important question, I guess, when we know what they are. So let's quickly jump into the first topic, understanding what fixed income investment is. Alan, I know there are a lot of questions, and we can probably spend days talk about different types of bond investment. But I just want to, get your definition of what exactly is a fixed income.
Okay. Actually, I think, Frank, you touch on a few things, whether we talked about government bonds or, I guess, deposit. It, I think largely it can also be considered as fixed income. I think, as you mentioned, as something that's more straightforward. It's really about that, income and whether you have that predictable cash flow. So I guess if you look at in a very old school way of defining fixed income, they are largely we are talking about these bonds that issued typically by government, or state government, government agencies, supranational organizations, and large corporate. And that's how you typically look at it, define where when you're going through your investment menu. When you're selecting different fund managers, you'll probably see a large category of fixed income managed funds, and then they are largely in the space of investing in bonds. But I think that a more modern approach to fixed income it goes beyond just one single asset class. I think fixed income, when we work with many different advisors and individuals, when we look at investment options and portfolio constructions, I think from the investor's point of view, fixed income really becomes something that where going back to that fundamental logic, how do we design the portfolio that can actually help us with a predictable cash flow into the future. So actually, Frank, if you don't mind, can we go back a few slides? I just wanted to perhaps highlight on that. There's a 4-quadrant. Yep. Okay. So I guess if we look at the upper left-hand corner, interest. So that is where basically the traditional fixed income being defined, where it's like you derive your income by collecting interest. So whether it's people borrow money from you, whether it's a government or whether it's a bank or large corporations, when we look at fixed income, is really more about lending, and as a result, you're being compensated for the interest payment. So that's one part of it. Right. So if we go anti-clockwise, going through the 4-quadrant, in today's world, I think that many advisors and investors are looking at different source of income, so that rental is important. That's like in real estate, but that largely also defines that not just rent, but also royalty, lease payment. So basically, that it's also a very important source of income that derive from the right of using certain assets. And then you go down, you go anti-clockwise, you go to the lower right-hand corner where we talk about option premium or premium in general, like insurance, right? So people being compensated by hedging risks. Okay, so that's also another form of income. And then largely we go to that first quadrant where dividends. So dividend is derived from the profit of the company or any association or partnership. So that largely defines where the income are being generated from those 4 different sources. Okay, so then if we follow that thought, and I guess today, obviously, we probably only have like 45 minutes left. We're probably just more focusing on the interest part of the different type of fixed income that that derive from interest, i.e., is the underpinning vehicle is basically a loan. So if we go to the next slide, Frank, thank you. So I guess that leads into we in terms of the next layer. If we peel that onion, we go into the next layer of looking at the definition between bond and debt. Again, I think debt is a very, very generic term that you basically use to describe all type of loans. Okay, it's as simple as the IOU contract, or like such as your mortgage, or your personal loan, or even your credit card. Right. So there's all sorts of different debt in the market now. But when something that can be called as a bond, that typically means that such debt has gone through the process of securitization, meaning that they have become a security. To become a security, there are 2 very important characteristics. One, it becomes transferable, and 2, it becomes negotiable. What does that mean? So transferable means that the security can be easily traded in the market between a buyer and seller. And then, if it's simply like owning a stock, for example, right? So bond, very much like equities or shares, is a form of security. So I can buy and sell that easily. And so that I can change the title from me to Frank and vice versa. And then the second character is negotiable. Negotiable means that the price itself is determined between the buyer and seller. So that creates a free market mechanism where the people can easily trade bonds, in the open market. So that when we look at bond, it's a subset of debt, okay, and typically issued by large organizations that has the ability to actually go through the process of securitization and allow their instruments to be freely traded in the market. So then when you start owning bonds, then we go the next level deeper, you start to hearing more terms or some certain terminologies that associate with bonds, where they describe the different type of coupon payments, whether you have a fixed coupon bond or floating rate coupon bonds, or you have a different type of design features that can pay fixed for the first 5 years and convert into a floating rate thereafter. Then whether the bonds are issued by different type of organizations and whether they actually have any security back. So you might have heard like mortgage-backed security or asset-backed securities. They're all part of in that bond universe, and just a different subsets of bonds that are actually available. So and because that is the features of bonds, I guess I think that the important characteristics that they become a securities, so that can easily be used in clients' portfolio. Okay, or you have fund managers that will package a basket of bonds and they will manage that bond for you, and they will issue a managed investment scheme in Australia, as we call it, managed fund. Then obviously some of the really I guess well-known managers such as PIMCO, the largest bond manager in the world, or even I guess even ETFs, that they will also have certain strategies that actually track a basket of different bonds. Okay, so if we go down to the next slide, I guess that just give people a sense that bond market is actually bigger than equity market globally combined. Obviously, there's a large portion of it come from government bonds, right? So we often hear that US is reaching their debt ceiling. They need to borrow more money, and there's throughout the creation of issuing more government debt or government bonds is a very important mechanism for government continue to be well funded in order to be in operation. Okay, so but the idea you're looking at is it's just that the bond is not something that where they trade it in exchange. So unlike the share market, you see them on you hear them on the news, you see them on the screen every day, but in reality, the bond market globally is actually much bigger than equity market combined. Okay, so I guess that's kind of we're looking at the guys, I guess just a very broad sense in terms of what we're looking at today. And I think we obviously today will hope to address some questions and maybe look at some of different bonds as part of today's presentation. So very long-winded explanation, Frank. I can go on and on and on.
Yeah, I know. I guess with the we're trying to get a very straightforward and short definition for bond, and we realize that if we dig down deeper, it's just going to get longer and longer for the definition, because a bond is such a broad term. But one key takeaway from this slide is we understand that the bond market is way bigger than the stock market, and trading shares and trading bonds are two totally different things. Even though we think a bond might not be as liquid as we thought, but in reality, it's actually pretty liquid, right? So it's a very actively traded market. And from my experience, we have seen fund managers actually profiting from trading bond and actively trading bonds, and find out the differences that they can make out of this bond. And there are different strategies involved into this, and it can get really, really complex. Another question I really just want to ask before we move to the second part of our webinar today. So we have seen a lot of private credit. So there's a lot of mortgage funds, right? So they use the money to lend to a construction company, or doing a construction project, and issue a interest rate 9%, 10%, really high interest rate, for people that wanting to have consistent income. But what we realize is fundamentally these are very different things comparing to
Yep.
bond, right? So
Uh,
from my experience, we really can't categorize them into a conservative fixed income product that can be, distributed to the client, but instead it is more or less of sitting in that kind of alternative category. Are you able to just to give a little bit more information in terms of what the difference is with a mortgage, fund and versus, maybe a corporate, let's say CBA issued a bond, or share preference shares to the market? What are the main difference?
okay. I thought we are gonna save this to the last, but
Oh yeah, okay.
since you already
No,
opened the Pandora's box, no.
yeah,
It's a huge
yeah,
topic, and I think it's actually
but
very topical. And
yes,
I'm happy just to maybe we spend a few minutes on this
yeah,
again. I'm sure many of us would have seen some media coverage lately about private lending or private credit. Um, again, if we look at remember we look at the chart earlier, right? I tried to explain that a different type of source of income. In fact, bonds and private credit, they belong in the same category because the return or the rewards that investors are being compensated for is interest payment. Okay, it's all come from a loan. It's a form of debt. Why some people think that, okay, a lot of the mortgage funds, for example, let's say La Trobe, right? La Trobe probably being one of the largest mortgage funds. It's a non-bank lender, but they also have one of the largest. They're also a mortgage fund manager. I guess the question goes that a lot of people, when they look at this type of private credit, because the loans are sit within the structure of a fund. Okay, loan itself, like what we said earlier, it didn't go through the process of securitization. So loan itself cannot be traded or transferred. There is a process we call assignment. So the loan can be reassigned from one lender to another. It is possible, but loan itself, there's no open market to trade loans. So that's why when you look at, let's say, a mortgage fund or a private credit fund or private lending fund, they have a basket of loans, probably from hundreds to thousands of them. They are not probably as liquid, unlike bonds. You can trade in and out every day. You have to really sit out till the whole term of the loan until the manager recovered the principal back. So I think it triggers two things. That one, obviously liquidity, as we talked about now. Two is really about the valuation of your underlying loan, right? So I think there's a pros and cons to that. I guess that level of transparency. Now, some people may argue that, well, I don't know how you guys price the loan so that you always just keep them at 100% as basically at the face value of the loan. It's probably not a good practice. But on the other hand, it also provides that stability when it comes to how you are unit pricing or valuing. So when you do the NAV of those funds, the NAV never change. Okay, so this is not the same thing as you were looking to bonds. So I guess in our opinion, both bonds or private credit actually forms a very important part of the overall debt market. In most of the terms that when we talked about bonds in general terms, we consider as they are unsecured credit, i.e., they are debt liability obligations or liabilities. But most of the bonds that issued by, let's say, big banks, right? Because the big banks, they are under the scrutiny of the regulators. They have a capital reserve. So most of the bonds that issued by the banks, they don't have a collateral posted specifically for that bond. We rely on the credibility of the issuer, their credit rating, to look at it. Do we think it's safe to lend money to them because they are large, reputable issuer, whether they are government or banks? But when we look at private credit, most of the time they would have a collateral. If we look at La Trobe, that's a mortgage fund, they actually have the underlying properties or the real assets will be used as a collateral. Okay, so so I guess the risk, there's a large degree of risk that actually is on the how much what's your loan value ratio when you decide to lend money to against the collateral that you're holding, and also the profile of the bond. But I guess today we are looking at a private credit that industry has grown to I guess more than just doing a first mortgage on residential properties. They become a lot more corporate lending. They may use collateral of account receivables. They may use other form of collaterals or purely just a trade finance. So I guess when we start looking at private credit, that itself nowadays become an asset class on its own. So I think most of the advisors would categorize them as an alternative in your allocation, because not every private credit managers are trading the same instruments. For example, the exposure that Magic has will be quite different to La Trobe. It can also be very different to, for example, to Moelis or Wingate or other peers in that group. So it's very hard to compare. I guess private credit or versus the ordinary fixed income manager, because the underlyings are actually quite different, although they belong in the same universe, because they are basically lend money to people and receive interest income.
Really good insight. That's a really good insight for us to understand what private credit and how the bond market really works. Because I guess from everyday mom and dad and normal investors, what they're really interested in are just how much return that I can get on the interest,
Yep.
right? And when we're getting down to analyzing the risk, it just get way too complicated for normal people to comprehend, because you would need to have that level of understanding. As you said, different funds, different managed investment schemes, they might have different underlying debts that's there and secured against different assets. So that adds complexity. But on the face value, they only want to say what the investment return is. I guess we need to move on to the second part. And we're always talking about products, interest returns, and things like that. It's very easy just sitting down here and talking about, okay, this gives me 7%, this gives me 8%. But I guess it gets down to in what situation or scenario is best to consider, okay, I need to have some secure income coming in for my wealth creation, and that's gonna help us to provide either certain stability or whatnot they wanted to have in their own portfolio. That's what I really wanted to expand with you a bit further, in terms of, okay, now I'm sitting here, I have some money, do I really need to consider fixed income as part of my asset?
Yep.
Some of the questions here for you, and I guess your insight is very important, the past and the future. I wanted you to share that with our audience today.
Sure. Okay, I guess I think we already had some questions posed in the chat room, which is great. I think we can definitely talk about risks as we go along, but the ultimate risk would be the default of the borrower or the issuer. So it happens as someone that couldn't fulfill their obligation. Obviously, most of the bonds are issued by large organizations. So when someone default, that means that they may not be able to pay their coupon in time. It will then reflect on the market price of the bond. Companies don't go bankrupt overnight. Right? So typically what they would do is they will ask they will write to all their bondholders to consider any proposal of restructuring. Okay, so we call it a DOCA. So basically, it's a kind of a restructuring proposal from the borrower to each, to the people who lend the money to their creditors and say, hey, can we, can we lower the interest payment, increase the term to another 2 or 3 years, asking for extension, because we are hoping that we can turn the company down. And they would go through that attempt of restructuring. If all possible means fail, then they will file liquidation, and typically that will be the petition from all the creditor to the court, force the company to go into liquidation. Okay, so or typically when you go into that stage, it will be in the hands of the voluntary administrator. Okay, so that's probably what you see. Okay, I think, Frank, back to your question earlier in terms of how are we using fixed income the portfolio? Perhaps we can actually share some slides. I think that fixed income or equities, in our very standard approach to portfolio construction, you'll definitely have them. Okay, whether when you're looking at your balanced portfolio, you definitely always have a mixture of growth assets versus your defensive assets. So I just wanted to perhaps give some perspective in terms of I think that everyone would always have exposure in both equities and fixed income. Now, the first chart that right now we have in front of you is just looking at our ASX 200 index. If you purely look at the price return over the past 10 years, you achieve an annual result of 2.89%. Okay. If you go down to the next slide, Frank, if you also consider, in addition to the price return or the capital gain you have made, we also need to consider the dividends that you have collected over the last 10 years. And that will bring the total return to about over 7% per annum. So dividends is also a very important source of income. Okay, so I think we also highlight that in the earlier slides, that we cannot ignore where profit are being shared from those well-managed corporations, where we become part of their shareholder, right? So equities, then this is the basically the number that you see over the last 10 years. Obviously, when you start to go much longer time frame, you try to broaden the time frame to 20 or 30 years. And then you start to obviously see the numbers that, in terms of, moderating, or I guess in Australia's term, but if you go really 20, 30 years, the numbers are actually probably higher than the return you would have achieved in the last 10 years. But that's kind of equity to give you just a bit of overview. And you go down to the next slide, then we start looking at how, if you are holding cash. Okay, so this is basically a bank bill index, also published by Standard & Poor's. So what is the bank bill index? Basically, is they track 3 months basically swap rate between the banks. It's basically very much to someone you are just rolling over your cash in a 3 months term deposit. Okay, so over the last 10 years, you will achieve about 1.99% if you just keep rolling your cash in a 3 months term deposit. That's how much you will get. Okay, so by holding cash. Now, next slide, then we'll start talking about bond. Okay, so I think everyone's portfolio will definitely have exposure on ASX. You will collect dividends. You will have cash. You will definitely also have some bonds, or in the bond funds, for example. So this is again also S&P chart. It tracks a basket of all the large bonds that issued by Australian large corporates, and they basically compile all the bonds that has, when they issue, that will have, in terms of maturity profile, between 5 to 10 years. And when they aggregate all those bonds together, look at the last 10 years, the annual return is around 3.8%. Okay, so that gives you an idea and picture that if someone have a well diversified portfolio, you will have all three components that we spoke earlier, right? You would have equities returns plus the dividends. You will definitely have some cash allocation and plus some defensive assets involved. Okay, so I don't think that we need to argue which one's better than the other because they all play different roles. And I guess when we start looking at the use of fixed income, whether you're relying on the manager to manage a basket of different credit or bonds, or you are looking at buying a single bond from just one issuer, the mentality is actually going to be very different. I think, Frank, we can probably go into the next slide. And this is probably one of the important aspects we want to talk to today's audience is that when you look at fixed income as an asset class, let's say, look, I'm happy to invest in bonds and I'm going to use a manager. So let's look at a manager, what's the track record, right? Because a fund manager, they typically have, let's say PIMCO, even the biggest fund manager, the global income fund, they have on average, about 600 different bonds that they have in their, under their management in the basket. So you will need to actually look at the past performance of the manager compared to the benchmark and to see that whether the manager is consistently doing better than the market, right? So, and that forms the investment thesis or the due diligence processes among the investors and also largely many of the advisors. So you need to study the pattern in the past to determine that whether we should have some allocation with this manager going forward. But when you start to looking at a single bond versus a bond fund, the behavior and the way that you need to analyze is actually very different. Because when we start looking at a single bond for our clients, they are not really looking at the past performance of the bond because they were not issued. Okay, there's no point of looking back in the past about how much return or coupon a CBA has been paying to the past, to the investors in the past. There's no relevance of the past because bond is about the future. You are about to lock in your future cash flow. So this become a very powerful tool when we sit down with an advisor, to work on a client's portfolio construction. Then we start looking at, okay, now how old are your clients? What's the cash needs? How much cash flow that we will need to be able to generate. So more and more, when we start working with more advisors start to realize that, no, I cannot use the same mentality, look at a bond fund versus if I'm actually putting a direct bond investment for my clients. So for the one I'm putting in front of you was something that issued in November last year from CBA. And so CBA, again, this is for wholesale clients only, but I'm just making this as using an example that CBA is going to pay the bond investor 6.15% as a fixed coupon for the next 10 years until 2034. And on that day, CBA as an issuer, they have the ability to call it back. Okay, for example, like refinance, right? It's a bit like, if the interest rate in 10 years time, it's probably cheaper for them to borrow elsewhere. They will say, hey, investor, thank you for lending me money for 10 years, and here's your principal back. If they don't call back in 10 years time, this bond will become a floating coupon, which they will use a BBSW plus a fixed margin of 1.65%. So as you can see, as an investor or advisor, when you look at an instrument like this, you don't go back and study the past performance. What you will need to look at is, okay, how do I compare CBA versus the other banks? Okay, and our team, for example, we do a lot of deep analysis on their financial statements, their financial reports, just to look at in terms of their free cash flow, their credit worthiness, and how healthy they are in terms of are they pricing at the right credit spread in terms of the risk, and whether they're having any negative outlook that posted by rating agencies such as Standard & Poor's, Moody's, or Fitch. Right. So being a fixed income specialist, we do research to ensure that those issuers are, they are always stay above in terms of the loan serviceability. Okay, so and that's what we care about. We want to make sure that this issuer has the ability to fulfill their obligation because you lend them your hard-earned money. We want to make sure that they in terms of in terms of going concern, that they don't pose any default risk for our clients. But when we're looking at bonds, I think that the whole due diligence and your investment decision making process is actually quite different when you compare to other instruments that today you have in the portfolio. I'll probably take a pause here, Frank. Yeah.
Yeah. I mean, for the past maybe 20 minutes, we're just talking about concept, right? The moment when we have the poster on, I guess you grabbed everyone's attention and they're starting to have a better understanding what bond is, right? How these actually work, and they know what the interest rate would be like, and how this whole thing operates. But obviously we can see not just not just the interest rate. We actually have detailed ratings in there, due diligence to understand what this bond is and how this is priced in the market. I guess it's this is another thing that comparing to private credit, right? So if you go to a fund and they say, oh, we're going to give you 10% interest, and the other fund says, I'm going to give you 9.5% interest. It's practically impossible to get in. So, look, can you give me a rating? Can you tell me, how this due diligence is done? What your compliance process is? It's very hard because it doesn't have that level of transparency, right? So, but here you can actually have a very high level of transparency to see what you're getting, and you can make a judgment comparing to other similar, banks that issuing the bond at the similar credit rating, and what their interest returns are.
Yes.
Yeah, and provide you with a wide variety of selections there. And as you said, providing with one single bond, it provides certainty. I guess when we work with a lot of retirement clients, that's one type. They wanted to have consistent cash coming in. They say, look, we want $150,000 from our super money. We just want to make sure that every year we receive that money. We don't want any volatility to our investment. That exactly provides what the client wants, right? And another part we will see is, clients coming into Australia and they have no idea what the investment environment is. So look, we wanted to make sure that our capitals are preserved. I guess the next chapter is going to give us a better understanding of what is available on the market, how we actually do this to achieve, what we just talked about, generating income and preserving capital. I guess it's, people are going to get really excited to see the options available in the market there. Okay, I'll leave the time to you, Alan, to walk us through what kind of stuff that we're dealing with every day.
Sure. Thank you, Frank. Okay, so we share some examples. For example, in terms of where you'll be able to access this type of products, and what are generally available to the public. Here's a caveat, though. That it's quite unfortunate that I would say 99% of the bonds in the fixed income space tend to only exist in the wholesale market. The reason being is that predominantly bonds are issued, traded among the large institutions. Okay, so we only have a very, very small number of offerings that make available directly to the public, i.e. retail investors, and most of them are probably, you can find them listed on ASX. For example, the one that we put in front of you was one of the capital notes issued by Macquarie, and it's listed on ASX. So the ticker is there on the screen. So what it does is that it pays a floating rate based on the 3 months big bank bill swap rate. So currently is about 4.1, and every quarter they will reset it, and then they put a fixed margin of 2.65%. So the current quarter is about, you're probably getting paid 6.75%. So a product like this is probably one of the few. There's probably just about 30 odds of them altogether that's listed on ASX. But there are, technically speaking, there are more categorized as preference shares rather than bonds. Okay, So we call them hybrids. They are really kind of sit somewhere in between bonds and shares. Why they are hybrids is, or why we consider. So in the States, this type of instrument are called preference shares. Reason being is that they don't have a definitive maturity date. They can go on forever. Okay, so there's a perpetuity in this type of instruments. Number two, the distribution that they're paying is not considered as interest income. It's actually considered as a dividends. So they come with the franking credits. Okay, but this is something that I think they're very popular. Again, so they are still available on the market if you want to look them up on ASX. But at the same time, APRA has come out and made a recommendation that the banks should no longer issue this type of instruments to retail investors. APRA, which is our banking regulator, believe that a lot of retail investors probably cannot understand the risk thoroughly. So they've asked the banks to cease issuing any new capital notes going forward. And we expect that all the ones will probably get called in the next 5 years. So so while they're still available on your screen, so they are quite precious right now.
Yeah.
But they're all floating. Okay, so that's different to the one we just showed you earlier. There's a difference that where for this type of instruments, that your return goes up and down depends where the interest rate is going to be. So so it comes down to that how if you wanted to let's say lock in your future cash flow, floating rate may not offer that I guess ability. But having said that, right, they were picking up. They were very popular 3-4 years ago when we are in the middle of COVID, when our cash rate is very, very, very low, close to zero. So we had advised a lot of clients back then to use the floating rate because when the rates start to go up, they will start to see their in terms of return or the distribution will continue to go up in terms of in accordance, according to where the cash rate is. If you would have done, a fixed coupon bond at the time of when the rate was very low, then it could be quite detrimental. Okay, so so that's probably available for retail investors. And if you go down the next slide,
just so before we go on to the next slide,
sure.
I need to let everyone know that we didn't actually say the disclaimer today because we're talking about products, talking about different concepts, and just letting you know we have no intention for you to type in the code and purchase this on ASX.
No,
just
true.
our webinar today. So everything is just for your own information. Is not really tailored to your situation. Okay, so not something that we put on the screen that tomorrow you're gonna go and buy it, and we take no responsibilities for that. And I just take this opportunity because we're going to introduce a few more different types of product. Because usually when we get into the fixed income, we try to, as use an analogy like a sandwich, we try to have different layers of fixed income to have different type of, security. We could have preference shares, you get a dividend income. You could have fixed income like interest coming in. You could have bank deposit as well. So with different layers lined up, then that could ensure that you have a consistent income coming in and also diversify your risk, not put everything into one single product. As Alan's team is always having new product coming up, and then there's the different rates, different features that can be applied to your strategy. Okay, so let's move on to the next one. It's going to be exciting to see some other different products available on the market.
Sure. I guess one thing we also like to highlight and share with our clients is that this is probably another feature, unlike share market, bond market. It's actually there's no bond of country or currency limitation. So one very important, I guess, niche or gap we're seeing in Australia is that we have a lot of clients come to this country, whether they come here with US dollars or British pounds. We actually have, we have an actually large portion of UK immigrants, or they are, coming for retirement. Once they were moving their UK pension here, some of them, if I guess most of the advice they receive would be, or you just need to convert to AUD to Australian dollars before we can even do anything, right? So I think that fixed income market or bond market offer that such flexibility for the clients that where we can actually help. For example, Frank clients, if they want to hold in US dollars or GBP, we can actually help them to select the solution that to meet their needs. I guess there's no boundary in the bond market or fixed income market there, so client can easily transact in the different type of currencies. So the two example we put in front of you was something that is also quite popular. Whether it's a US dollar issued by a UK bank or a British pound bonds in GBP that issued by a Netherlands bank, ING. Right? So this is something that we're I think that adds that extra layer of flexibility. Now, again, like what Frank said, not really, we all these products are wholesale only. So today we are just, going through some case study. We're definitely not giving any personal advice. It's probably always best to discuss with your advisor, what's the most suited solution. But again, these are for wholesale clients. So, it's quite unfair that, retail clients that would not be able to access the type of products. I think it's just one of the disadvantage. I guess the problem with market access to the wide. I guess the next slide, Frank, if you don't mind.
Yeah, I think the next one is going to be interesting because a lot of people heard the word structured product, but they have no idea what structured product is. I guess it's a really good opportunity because I have spoken to a lot of either advisors or bankers from the private banking sector of these major banks, and structured product is always their biggest selling point to high net wealth client. Even for clients overseas. So I guess it is a really good opportunity for you to walk us through and see what exactly is a structured product.
Sure. Again, this type of fixed income, it's in itself consists of bond plus derivatives. So it start to become more prominent and I guess acceptable to some high net worth clients. Again, there are wholesale clients only, but we use one as an example here that just now the bonds that you guys see earlier, basically the bank just pay you a vanilla bullet interest. We call them coupon. Okay. Now, some of the banks and say, hey, our clients are actually looking to enhance their return. They don't mind taking on a bit more risk. Can the banks that put some products together, as we call them, structured products, and the return here are actually derived from option premium. If you guys recall, we talked about the 4 quadrant earlier in the presentation: interest income, rental income, dividend income. This is here we talked about as a premium income. So in this example, right, for example, Citigroup, it's a very common product they issue that where they put 3 companies. Let's say this month they're doing Amazon, Microsoft, Nvidia. Pretty much. We're talking about the largest company in the world. They put that in the basket and say, as long as this 3 companies that doesn't fall more than 50% in 3 years' time, the bank will pay you a fixed coupon of 8.8% per annum for 3 years. Okay, so you go, where's the risk? The risk is if any of that 3 underlying shares actually fall more than 50%, you could suffer your loss of principal, meaning that you're probably prepared to actually buy the stock, at a below 50% of their price today, right? So So there is a risk associated with that, and how are the clients are being compensated for the risk they're taking is the client are basically selling a put option, like insurance. On the downside, the client are selling the insurance. That's why the clients are being rewarded for the premium that the bank is paying. The bank actually buy the insurance from the investors. So I want to use this example to explain that that is where you start to look in the structured products. Some of them you might have heard some really hairy stories about some people lost a lot of money, and it really comes down to in terms of whether the clients have been well advised, whether that the risk has been explained properly to the clients, whether that is actually the right solution. So I guess like for example, when we work with Frank, it's always about the KYC and KYP. For us, we look at it, they are equally important in terms of knowing your client and knowing the product. So we want to make sure that when someone look at the structured products, I think that they deserve a closer look of how the income are being derived, where the risk resides, and also is the client actually have that appetite for taking on this type of risk for that additional return. So, but I hope this principle, I guess this example just gives you a very high level, view of the clients are actually receive some of those option premium. That's how they are getting that extra cream on top. Yeah.
That's great. I guess it can get pretty complicated with the structural product sometimes to understand how it operates, and especially when we talk about different put options in there. If that's something that anyone here listening or in the future listening to the recording is interested, by no means we can definitely lock in a time to have a chat and see how this is going to fit into your own strategy. I guess now we're talking a lot about this on the wholesale client. That's where a wholesale client can actually purchase. That's the reason why not a lot of people know where they can buy this kind of stuff. But just today we definitely need to talk about where are the distribution channels, how these can be purchased, right? So that's the first thing. But second is how do I qualify to be in a wholesale client? Because it sounds like a very a big word, but is it very hard to be a wholesale client? How this can be defined? Can you walk us through the wholesale client part, and then we can talk about what the distribution channel is.
Sure. Okay. Well, um, um, uh, under the Corporation Act, it defined the wholesale clients or investors with three criteria. Investment in the same asset class with a sum of over $500,000, or with accountant certificate that of a person has an annual income of 250,000 or more in 2 consecutive years, or a net asset have of 2.5 million or more. Becoming a wholesale client isn't just about whether you're financially qualified. We also need to look at the experience of the client, whether they actually have that level of understanding and sophistication. So we don't normally take the wholesale definition lightly, because as someone qualified, we can sell them anything, right? It's really a test to clients that whether it's not just. I think it goes beyond money. We also just want to make sure that once a person becomes wholesale, yes, it has exposure and access to a lot more products, but obviously the risk had also gone to the next level, where the advisor that you use is actually can actually help you to navigate. Right, so that I think that's very important. Unfortunately for us, why we talked about a lot of product today, wholesale. It wasn't by design. It was because those products were initially issued or being created for the wholesale market. Okay, so I want to use an example, like when we talked about those bonds earlier. When the bank, let's say CBA, issue a bonds, they probably issue in the size of 500 million or to $1 billion. Their primary buyer of CBA bonds are other banks or large institutions such as your super fund or some of the fund managers. Why ANZ or Westpac or NET want to buy CBA's bonds? Because once they bought their bonds, they can take the bonds to RBA as a collateral for them to borrow money against. So in the market, we call this as a repo, as a repurchase. It's a very important function of money creation and how the entire credit supply and treasury work. So in every country that the banks will always issue and hold other banks' bonds, and they are repo eligible with the central bank. So they were never designed for retail investors to participate. Okay, that's why I think there was no means of discriminating retail investors. It's just that the entire market was designed for institutions. But I think that with our wealth growth, as we approach retirement phase, then obviously with the assets that investor has accumulated over 30 or 40 years of gainful employment, or with a successful collection of your property portfolio, then we start to see a lot of investors actually qualify for wholesale, and then looking for different solutions that to actually achieve their investment outcome. So then we start to introduce something like, for example, bonds, right? So again, the definition of a wholesale, it's defined in this country under our Corporation Act. Everyone can Google it. So it's written in the law. I think as an advisor, when we go through testing someone's wholesale status, it's also more important for us to understand that whether the person actually knowing what they are getting themselves into, because become a wholesale, you actually sign many things away, including your, your protection under AFCA, i.e., that what they used to call the. It's basically it's a financial complaint authority that basically look after any client dispute, retail client dispute. But if you're wholesale clients, you won't get the benefit of protection. That ombudsman, sorry, that was the word I was looking for. I'm sorry, ombudsman, yes. So you can consider that as a consumer protection. But once you become a wholesale client, you lose that consumer protection, right? So I think it's got to be very careful about that. And I guess then, Frank, to your other question about in terms of where are the distribution channel, you're right about some of the private banks that they do offer. Not all private banks in Australia offer that. You might be able to get from NAB or Westpac, but I think right now CBA and ANZ they don't offer such solutions. I think, or to some certain individuals that where the investment amount are quite large. But typically, a private bank would have some of the exposure or access to it. And then other than that, yes, I guess some of the private wealth advisory firms would also offer some access. Not all of them. It really depends on whether they have this as a class set up. I guess we are being bond broker dealer. We definitely work in that space that where assist investors more so with advisors to access this type of product. So it's not something you can trade on the screen or something that you open a CommSec account you'll get access to, because this is we're talking about OTC market. It's defined for over the counter OTC. it is not traded on the stock exchange, so that you really have to go through certain banks, uh, uh, specialized brokers like us, to help the clients to access this over-the-counter market, to be able to buy and sell those instruments. Yes.
That's great. I guess, a couple of other questions that we want to touch on. One that you already mentioned is not just for retirement, because it's actually available in various different currencies. So, for example, if a client holding some US dollars or British pound, and they can always actually settle this investment with these currencies instead of converting them into Australian dollars. Well, they need to bear the risk of the exchange rates. That's one thing that is not commonly available to you if you want to purchase shares on ASX, using a different
Mm.
currency, right? So that's definitely some interesting part that people should understand, that there are always investment options available if you're holding other different currencies. And another part is with the capital preservation. We have a lot of clients coming to Australia and they don't know the investment market, but they have one goal is, I don't want to lose any money. I wanted to see it grow, maybe to a certain level, better than the term deposit, but I don't want to lose anything, right? So that really allowed them to have that kind of capital preserved. That provides a foreseeable future, right? So what's going to happen in the future versus buying shares. You were just looking at what happened in the past. Another important thing is we often seen, you get a very favorable tax rate in Australia if you're investing as an overseas investor investing in Australia, because the interest is only taxed for 10%, right? That's another important aspect that people put into consideration, because if you get an interest and then you get taxed as a non-resident for tax, over 30% tax, then that's not very favorable. But instead, the interest in Australia as a non-resident is only taxed for 10%. So it's very interesting dynamic when we're looking at retirement people. People are in retirement phase versus people are overseas investors. Two entirely different market. While we're using the same product, but you might actually benefit in these two different scenarios. Was there anything in particular, people that in their lives, that you think you would benefit with these fixed income products?
I guess, like you said earlier, right? I think in the earlier part of the presentation, we also talked about in terms of equity performance, including dividends. It is actually quite common that when we are looking at some clients, that when they go through a different phase of their life cycle, different life stages, the older they are, they get to that stability of their principal, and also that the stability of the cash flow become even more important. So I guess just to your question also earlier, that about in terms of the tax issue. So when some of our clients start to consider using fixed income or bonds as part of their portfolio, they while the income will be treated as ordinary income, and when they are making it's also possible that people can make a price gain of the bond. Say they don't necessarily have to hold till maturity, right? So, for example, some of the more tactical clients, they are not just purely investing for the cash flow. They're actually taking a view of where the future rate may change, and they want to lock into using fixed income to take benefit of, let's say, interest rate easing cycle. Okay, as we go through interest rate cuts, they're expecting that some of the bond prices may go up. So they might be able to capitalize, some of the gain on the price of the bond itself, in addition to, in terms of the coupon they are collecting. So, so I think, like you said in the beginning, it's on the surface, fixed income looks very boring, but once you dig deeper into it, it's actually a very fascinating asset classes that were, for example, some of the bonds that were issued, like 2023 when the interest rate hit the peak, like we have some banks that, like I said, Westpac was paying like over 7.2%, 7.199. And that was the pinnacle. I think a lot of clients rushed in and locked in 7% for the next 10 years. And guess those bonds are trading at about $110. They bought at hundreds, now 110, while they've been collecting over 7% interest. So so I guess it really depends on the different type of clients. Some clients, retiree, are purely using that as a cash flow replacement. Some clients can be quite tactical in terms of how they are actually using this type of instruments. So yeah, it's actually catered for many different type of investors. Depends on how you use those instruments.
Yeah, that's pretty exciting. I mean, like if we get into too much of a technical these terms in terms of how bonds are priced, how we profit out of it, probably that's going to be another session that we need to run. I guess today with the past 60 minutes, we gave a really brief view in terms of what the fixed income is. Some of the main differences between a private credit fund and the normal mortgage fund that you can see on the market versus the bonds that you can get, and also some of the preference shares and the structured product. Some of the examples, and also Alan explained what is a wholesale client, right? So some of you might be qualified as a wholesale client, you're just not aware of it. Some of you are already a wholesale client, but probably with the knowledge side are not up to that level. Where we're all here to help to make sure that we can provide the best solution to you. Because for me, I'm excited about the shares, about managed funds, but a lot of other things. But the more I learn about fixed income, the more I realize that these are, exciting, as you said, exciting asset class that we need to introduce to everyone to help more people understand what this is about. I guess we're already over the time. Just wanted to see if anyone has any questions that you wanted to put on the screen. So I will get Alan to answer these questions. But give it a few more seconds.
Yeah. Or maybe we can go to the next slides where we have our QR codes.
Yeah, that's right. So I mean, the fixed income, I have to say there's not a lot of people actually in this space, especially, advocating this particular asset class. And this is really our pleasure to have Alan here today. And I want to be, also an advocate for this type of investment to help people understand. Because, when we're talking about a wholesale investment, it's a very product specific solution, right? So it's we understand the situation, but it needs to get down to what kind of pill or medicine that could cure this specific needs that we wanted to have. So with this QR code, everyone can do a screenshot. If you listen to a recording, you can screenshot on your phone or on the computer. By all means, add Alan, contact his team to understand what is available on the market. And to be honest, these are things that often coming up. So there's always exciting things coming up, and it's like maybe new cars, right? So you're just excited.
Yeah.
What's the next new launch? And then if you add Alan in, definitely his team will be able to share these exciting new products with you. And for us, if you wanted to have a chat in terms of what is the best solution for you, also scan the QR code. We're more than happy to lock in a time with you as well. Okay. I mean, we have the disclaimers put it in here at the last page.
The most important slide.
Yeah, it's the most important slide. We should actually put them on the first page.
First page.
Yeah. So I understand this is a very complex topic. Then the time when I was thinking, we should do a topic about fixed income, I've been hesitating to say how we can make sure that in a 60 minutes time, we don't boring people to death, because this is something that people think, naturally it's a bit boring. But I think definitely we struck the word smart, and we can play this smartly. with different strategies, and what is the right thing for you. Obviously sitting down with us to understand the solutions. Yes, we have one more question. So
Yeah,
many people
so
advocating this type of investment
from
product.
Xin, yes, I guess just because of OTC market, they're really mainly designed for for institutional. So I guess I think um, we've seen some players try to disrupt this space. Obviously, I guess we are also trying to break down that that access barrier. But I think that is really more driven by the law and also the cost of in terms of um, maintaining that I guess that um, uh, for example, your unit holder registry, right? So, for example, for CBA or for all those big banks, um, they can easily raise billions of dollars from the institutional market already. So there's no need and incentive for them to come to a retail market, because the issuing cost is higher, in terms of the regulatory scrutiny is higher. Uh, so if CBA, that they can easily borrow money from other large investors, they don't really think of they need to do this. So that's why I think a lot of the retail investors are really being kept out of this market, and you can only go through some fund managers to get access. And that's where we come from, right? So, like myself, I spent 25 years in this space where we realized that a bond fund works quite differently to a bond. So some people that can benefit from getting a diversified basket of bonds through a very qualified manager, they probably deliver really good return. But again, the market in terms of the distribution you get from the bond fund and also the value from the bond fund will also fluctuate. It will also go up and down. So I guess that is where we see there's a gap. I mean, the demand is there, but how do we break down that access barrier? So I guess that I think we do believe that many clients that have very strong needs, especially a lot of the advisors we work with, they've been using term annuity from Challenger. But if you look at the products that bring out by Challenger, you look at the credit rating of a Challenger and versus what you can get from CPA or ANZ, and you go, there's no comparison. You can actually get paid more by investing your money with someone that's even higher credit rating. So it's a no-brainer. So we believe that there's definitely a space for it. But how do we make them more accessible, and how do we make sure the client understand that the risk they involved? I guess that's kind of become our task.
Yeah.
So I guess that's why we decided to focus on this space and work with advisors on getting access.
That's a really good point, because usually this is distributed via a wholesale channel. And for me as an advisor, I worked in the retail space, and I realized there's a huge gap from a wholesale to a retail distribution. There are really good solutions there, but it's not commonly available to a lot of retail clients who actually can be qualified as a retail client, wholesale client. So these kind of gap needs to be taken down. But the reason why these major banks are not really focusing on this is because the cost of promoting this versus all the returns that they can get out of this, it just doesn't make sense to them. And that's the reason why we have Alan and myself, we joined together to be an advocate of these type of particular asset class. So hopefully, Alan, I would be able to invite you for another session so we can dive in deep to other aspect of fixed income, or maybe more on the strategies. But everyone's listening, or whoever's listening to the recording, feel free to drop in your comments so we know exactly what you want, what you want to hear. Then we can tailor the content to your needs. Okay.
Excellent.
So
Well,
hopefully,
thank you, Frank.
not a problem. Well, it's our pleasure to have you here today. And I guess with a lot of information packed in the 60 minutes, if any one of you or audience listen to the recording are interested, scan the QR code. I'm gonna go back to that QR code again. before we wrap up the whole session today. So just do the screenshot, scan and add with on, and then we will be able to talk to you about your particular thoughts. And thanks again, Alan, for your time today. Thanks everyone joining us
Likewise.
today for this lovely evening, and I hope everyone have a good evening. And we'll see you again in our next Xin Wealth Talk. Thanks
Excellent.
everyone.
Thank you, Frank.
Bye bye.
Bye bye.